Yeah, thanks very much, guys. I guess, first of all, I'd like to say huge thanks to Mantle team for putting together such a great event, and not just this one, but also what they've done last year together with Gadgets. On the note of our Mantle extension, we've been really kind of pleased to build extension with Mantle team, who helped us tremendously. And actually, it's also been based off Gadgets. So both kind of Mantle and Gadgets supported, the way we managed to roll it out. I'm really kind of happy and very kind of thankful to them for that. So my name is Alex. I've been around Shopify ecosystem for the last kind of 3.5, 4 years. Before that, and kind of in general, over the past sort of 18 years, I've been in finance industry, kind of doing different things, still kind of contracting with kind of large financial institution, helping out with the capital structure for medium-sized kind of large companies, but also the small companies. And what brought me to Shopify a few years ago was the desire to invest in this space. I've been kind of doing my own e-commerce. So I used to be a merchant about sort of 12, 15 years ago, managed to develop this business in a nice kind of a wholesale model. And, partially it was sold, which allowed to take some money off the table and start kind of investing. And the best sort of point was to actually invest in SaaS related to e-commerce business, which I was familiar with. And one of the models we decided to choose eventually was so-called revenue-based funding. So those of you who are familiar with Shopify Capital or Stripe Capital, by and large, it's a similar product, but just designed and developed specifically for Shopify app developers and Shopify partners more broadly. In any case, what I want to talk today about is very much, the capital for growth and how, do I kind of look at the continuum of options that are available to you guys, and hopefully we'll kind of give you a couple of ideas as to how you can approach the process of thinking about your capital structure and what are the options you can use on the path of developing your business. So why funding matters? And I guess it's not a secret for most of you, and your presence here probably proves the point that it's not just enough to build a great product, really work on the great code. You also need to go the length of building, strong marketing case, customer support, and other kind of bits and pieces which support the business and let it grow. Obviously, capital or the funding is one of those tools you can use. And the way I like to think about it is, whether you're bootstrapped or, backed by a financial sponsor of any kind, whether it's a VC, PE, or kind of friends and family, it's really kind of your superpower to understand whether it's the right tool and periodically review and, give yourself an answer to the question, is this really the best thing I can use? Also on that point, I'd like to say that I think bootstrapping is not necessarily kind of a default position. It's the choice to some extent that you make when you decide, I'm just going to kind of rely on my own ability to, generate enough cash flow and reinvest in my business. So the way I like to think about the options within the funding space is by applying this sort of a timeline. When I kind of usually divide it into 4, buckets, saying, the initial stage of the business is usually ideation, MVP, and then obviously early traction. When you get a bit of revenue, you're kind of getting those kind of early customers, you get a lot of feedback, and it's probably kind of starting to feel the product market fit is kind of firming up at this stage. And then finally, you get to the growth stage, expansion, scaling up, and the maturity, where you might be thinking about the exit or potentially kind of scaling up to the next level. And each stage, in my view, has its own kind of relevant tools you can use to, the benefits of your business. It's a bit of a busy slide, and we're going to spend too much time on it, but we're going to come back to that because that's just a kind of a useful representation of how you may think about the options, which has been, by the way, put together with the help of ChatGPT, therefore those lovely emojis in there. So on the horizontal axis, you've got some kind of increasing complexity of the funding sources, if you like, which is also related to the complexity of the underwriting from the funder perspective. And on the vertical axis, you've got the life cycle of your business, starting from the idea all the way to the large scale maturity. And You probably notice if you move from the left top corner onto the right bottom corner, that kind of a diagonal sort of path is kind of staying green. And that's pretty much just to give a useful representation of how you can think about kind of different funding options available to you through the life cycle. So we're going to dive into some of them in the next couple of slides. But just to say a few things, obviously, when you're bootstrapping, it's absolutely kind of appropriate at the early stage, and it's probably one of the best solutions you can find. When you're kind of growing, depending on the appetite and objectives you have in your business, you may actually stay bootstrapped if that's a lifestyle business or it's just giving you enough of what you need out of it. But if you're really thinking about growing and moving to the next level, then you may as well start thinking about other tools that you can utilize. Obviously, friends and family could be also kind of a great support and a good source of capital at the initial stage. And we're going to talk about, pros and cons of that later on. I mean, angel and the seed VC, I put rare because it's kind of a challenging thing, I guess, to raise in the current markets, especially if you're a Shopify app. It used to be probably easy in the past. Now we find that many Shopify app developers who are starting fresh journey, they find it quite challenging to actually persuade VCs to invest in them. But once you get early traction, you can pretty much open up some doors and have the conversations. But it's probably more appropriate when you've got this kind of a solid growth stage. You're definitely past this kind of a firm PMF point, and you don't actually need to prove much. You've got a GTM figured it out. You've got this kind of a firm PMF too. And finally, traditional sources such as bank loan, traditional debt from private funds. You may be surprised that actually at a later stage that really becomes an option. Not necessarily so much from the banks that are still quite clunky and find it difficult to understand what Shopify app actually is. But you've got more and more private funds popping up, and you might have heard that the private credit industry in general has grown massively. So some people estimate it's now at a level of 1.6 trillion globally. And this is the space where you have small and medium private funds looking kind of in particular for kind of different niches and opportunities to do funding for earlier stage businesses. Obviously, if you're VC backed, then there's another option available to you, which is venture debt. It's a very specific type of debt instrument, which usually takes the underwriting from the funder perspective in kind of dual track. So they want to make sure that the VCs backing you are strong enough, and you've got this kind of a continuum of being passed from, let's say, Series A to Series B. So there's somebody who's going to support you to the next stage, but the other part of the underwriting is still going to be actually looking at the credit metrics of your business and how strong you perform and how compelling your business case is. And then finally, at the stage of being mature, probably thinking about the potential exit, you can think of strategic investors, you can think of roll-ups that's also developing and popping up every day. And let's maybe move on and talk about some of those options in a little bit more detail. So the bootstrapping or indie funding, if you like. So that's obviously quite good at the early stage. You have control. You don't really dilute yourself at this stage. You can learn by doing, and that's kind of a great sandbox to experiment without really taking too much of a risk. I mean, the cons of this approach is obviously a slightly slower growth. You are somewhat resource constrained, which might not be necessarily a bad thing. As many of us have learned through the journey, that actually being resource constrained can incentivize us to be more creative, more inventive. And now with the help of AI, I guess, as Mo was saying earlier today, you can do probably 10 times what you used to be able to do in the past. So all of a sudden, that kind of cons becomes probably less of an issue. The risks associated with this approach, you probably all know quite well, the burnouts and the potential plateau that a business can reach pretty quickly, but also depends on the niche, depends on the markets you're currently sort of operating in. I mean, friends and family, grants, indie, again, sources and angels. Obviously, it's a fairly friendly type of capital. It's ideal when you need a fairly small amount to test certain ideas, iterate. So you're probably still at the stage of figuring out your product market fit. Obviously, it's quite kind of personal based on your relationships with people. It's often quite flexible, and you can pretty much agree the terms you like. you do probably run the risk of personal relationship strain, and therefore the tip is to probably try and set expectations very clearly, even with the personal investors. And we will also advise is to sign some form of agreement, even if it's a founder's agreement, which is more of a kind of a fundamental understanding of, what happens if. You don't have to think of all the possibilities, all the options, but to think of the exit, to think of how the evolution of your business may happen, and therefore how your kind of investors may be affected going forwards is usually quite helpful. I mean, revenue-based funding, I can obviously talk about it all day. By the way, who knows what revenue-based funding is in this room? If you can raise your hand, please. Yeah, I think most of the people here know it quite well. It's essentially a pretty simple tool. There's an example down there, which you probably cannot see. So if you, let's say, want to plug kind of a small gap or a larger gap in your working capital, or you're thinking of investing a bit more to accelerate your growth path, you take 20 or 50K from the funder. They charge you kind of a one-off fee. So let's say you took 50K, the fee is 5. So that's 55K is what you need to repay. And you usually pay that as a percentage of your MRR. It's a flexible tool. If your MRR goes down, so does the absolute amount you need to repay, unlike the bank loan. And once you repay that, you don't owe anything else. You normally don't provide personal guarantee. There's no collateral needed. So it's quite a flexible tool, which many people find quite helpful. And obviously, a lot of Shopify merchants have been using Shopify Capital, Stripe Capital, and other tools like that. I guess the key problem for us, kind of developers, is that Shopify Capital would usually provide this, or Stripe, for like duration of 4 to 5 months, which isn't really that helpful of a horizon. So we tend to want money for 12 months and longer, because that's probably the cycle we can turn it around and actually see some return on investment within the business. The bank debt, actually coming back to the revenue-based funding, that's probably more appropriate, obviously, when you have revenue stream. Revenue-based funding is normally not available if you don't have revenue, as the name suggests. The bank loans, I've mentioned already, said a couple of points about banks and private funds becoming more active in this space. Again, the biggest benefits, you don't have dilution. If you're looking at the bank financing, you obviously need to be profitable. You probably need to show them your kind of positive EBITDA and some track records of the company being profitable in the past. It's usually not enough to tell them, I'm about to break even, or I can break even if I want to. They would probably want to see some hard evidence you've done it in the past. I mean, the biggest sort of cons is, you actually get the burden of fixed repayments. It's a strain on your cash flow. You may require, to give the personal guarantees or additional collateral. So it might not be the easiest thing to arrange and also kind of get on grips with from the personal level. I mean, it's probably more appropriate for later stage businesses, when you have a steady flow of MRR, you are at a sustainable level of profitability. So that kind of additional cash outflow could be justified by leveraging your existing strength of the business model and getting like a disproportionate sort of outcome with the help of this relatively low leverage you can get. And some people may ask, like, why would you even take external funding? Why wouldn't you just kind of sit and wait to accumulate this cash from your own cash flow? Which is a fair point. But if you talk to the finance people, we're obviously biased, and we're going to tell you, hey, if you keep your money in a savings account, chances are the bank is never going to pay you the interest rate equal to the inflation rate. So therefore, your money depreciate in value. So you're better off, looking for some borrowing. As long as it's pretty much on par with inflation rate or even lower, it kind of makes economic sense to use that money to your benefit, because you probably have a much kind of better case of investing into something which generates and multiplies the cash flow, with the help of your business. What's kind of the right tool, and what are the pitfalls to avoid? So I guess the best approach here is to think, what are the objectives? What is it I'm trying to achieve? And pretty much back solve from there. So it really depends how fast you want to grow. What do you want to get out of your business? Are you okay giving up control, or would you rather kind of keep it? And obviously, are you building a lifestyle business and are quite happy to stay chilled out and not really kind of bother too much about this kind of a hyper scale of where you're going? Or are you kind of really ambitious and you want to kind of get on a path of being VC backed and just, get along with this kind of exciting journey? The common pitfalls probably worth trying to avoid is obviously kind of taking VC or any other kind of fairly aggressive type of investment early on without having a clear product market fit. There are exceptions to this case. Obviously, if you're coming out of the industry, you know the pain points really well, you've done it within the industry before, you probably have the know-how, and you are quite confident of being able to build what you're building. If it's not the case, though, and you're kind of starting from scratch, you're much better off looking at other sources of funding to begin with. And I guess it's never too late to turn to the VC capital. And I've got examples of like MailChimp and a bunch of other guys who only raised once or raised at a much later stage in their journey, which really allowed them to stay quite safe in terms of their capital and avoid a huge dilution at the initial stage. Over leveraging with that is definitely kind of a quite a real danger, and we do have a couple of clients in our portfolio where we think, you're quite reliant on the capital you're getting from us. Like, are you really capable of repaying and operating sustainably without our help? That's something to think of in terms of affordability, right? Can you really afford paying it back and sustaining your business without necessarily kind of needing to change anything within it? And obviously, planning ahead is a very kind of helpful way of thinking forwards and having a good idea as to what sort of tools you're going to utilize going forward. You don't have to stick to that. That's a really kind of a moving beast where you need to consider, reconsider, review, and decide whether this is indeed the appropriate type of capital, the appropriate type of funding you are using at this stage. I mean, I've got a couple of case studies, but just to kind of mention, ReelUp is the shoppable videos app, which we've kind of helped and kind of essentially allowed them to compete with a VC-backed competitor. And that's kind of the case where they've managed to get on a really kind of a strong trajectory of growth with the help of funding. We've been working with them since they've had their previous app, which they sold, and that's been a really kind of a quite rewarding journey with those guys. There's another one where we helped transition from the agency model to the app model, which again was quite interesting and quite kind of unconventional approach. To begin with, it was a one-time charge type of pricing and then kind of turned into a recurring model. And we kind of took additional risk with that, but helped the team to avoid equity dilution at the early stage. There's also kind of a more of a niche case where, we kind of plug the gap of our fairly kind of limited working capital needs to invest into marketing when a company was kind of trying to develop a couple of their flagship apps. So again, it's not always about this kind of a big change, hiring a bunch of developers, hiring kind of marketing person. It could as well be something relatively small where you can get quite a quick outcome and therefore have this kind of funding to help you out. I've got some metrics I can share. Depends on how much time we've got. You gotta go. All right, cool. So, I mean, that's the question I get to ask all the time. And, these are some of the metrics that we kind of look at, and that's what we've seen the wider investor community would want to see. Now that you've got Mantle, obviously, a lot of the stuff is quite easy to pull and show, and that's kind of a great thing you can enjoy. So it's obviously important to know your key metrics. Some of them may become vanity metrics, so you've got to be really careful. And again, keep reviewing, what are the things you really want to keep an eye on and what is critical for your business. But things like net revenue retention, or the other side of it, churn, is really important. The gross margin and where it should be, for you as a SaaS business, you obviously want to keep it at the range of 75 to 85%. That's what investors would normally expect of you. And finally, the growth rate. That's really critical. And somebody was mentioning today, I think it was Andrew from Cleverific, that the investors that are looking to potentially buy you up normally want to see 30 to 40% annual growth, which is the same that we're kind of seeing in the market as well. We quite like our, I don't know if we mentioned here, but we quite like the cohort analysis, which again, somebody mentioned earlier today. It's just a helpful tool that allows you to track how the performance of your business is sort of evolving through time. You normally look at the monthly cohorts of customers and revenue and how it performs. And what you want to see is that you're capable of retaining your customers better as you move down the historic trends, and also your ability to retain the clients as long as possible if you push it out. Yeah, I've mentioned most of them here, and again, it's kind of important to know your obviously sort of customer lifetime value, your acquisition costs, and unit economics, which you can derive from that. There are some other things, like magic number, the rule of 40, and some other stuff that is being used by the SaaS industry in general. But again, there's been, a good McKinsey study a couple of years ago, and they pretty much said, look, we've actually done quite a lot of work analyzing different SaaS metrics, and we came to the conclusion it's only like 2 or 3 of them that have a real kind of strong correlation between what's going on with the business and where it ends up in terms of enterprise value and the kind of the actual ability to grow and develop in the future. So that's pretty much it. I don't know if you have any time for Q&A.
Awesome. Thank you so much, Alex. We all really appreciate it.
Cheers, guys. Thank you.